Hi, I'm Jeanette Dias D'Souza, and I'm delighted to be with you here today as a volunteer with CPA Canada Financial Literacy. We're here to do a session today on growth and expansion, how to best grow your business. Welcome. A really great strategy to help get participants involved is to get them to volunteer to do certain things for you. You might get them to quiz people on what their background is, etc. And personally, I found it very helpful as people are meandering in. I usually go say hello to them, ask them where they're from, etc. I find it helps warm up the climate a little for the class. So, business owners out there, is it time for growth? You'll want to really think through some of the following questions and really have a good feel for your answers in order to determine your growth strategy. So for example, what are the best reasons to grow a business? When's the best time to grow a business? How do you plan for growth and expansion? Will growing your business increase your profits? How much cash do you think you'll need? And what happens if you get unexpected growth? Then what? One of the key reasons to grow your business is to keep up with demand from your customers. So how do you know whether you should or you shouldn't? Well, if customers are leaving your place empty-handed and you can't keep up with the product, then you know that there's a demand you can fill. If customers are coming in and asking you for things that you don't have, then you know there might be some other things that they want that you might need to consider whether you should have. You might also want to expand as a strategy to obtain new customers, or when there's new markets that you think you might want to address. In addition, you might want to expand because the competitive nature of your sector is changing and you see some good opportunity. You have to decide. So the second reason to grow your business is in order to remain competitive. For example, product requirements may have changed, so you may have to adapt to some changes. In addition, there could be innovation and maybe there's increased efficiencies that you want to take advantage of. In addition, there could be industry changes that are completely beyond your control. So for example, you could have had competitors that have entered the market or have left the market, and being the keen business you are, you have to figure, what are you going to do? So, as a business owner, when does growth make sense? Well, for sure you want to grow when you can foresee profitable growth. So for example, you know you have strong customer demand. You know that you want to remain competitive, and perhaps growth is your strategy to remain competitive. You have ready access to funding so that expansion won't be a problem. And you have the organizational capacity, the resources in order to meet your growth objectives. So these four elements for profitable growth will be explained further in the next few slides. So at this time we want to talk about, when does growth make sense? So it takes time and money in order to grow a business. So on the money side, there are various options. So do you have cash in the business? Are there investors who are going to invest in you? Are there loan commitments that you already have lined up? Or perhaps grants. Maybe there's something that you can apply for in order to help your growth. So in addition to the funding side, anytime you're considering growth, you'll want to take a look at your organizational capacity, because growth requires time and expertise. So do you have the required operational capacity, the required systems capacity? Can your management and staff step up to doing the extra bit? You'll have to assess that carefully. So in this particular slide, we take a look at the need for cash when one is growing a business. So when one's growing a business, usually you'll need to invest more in inventory, and very often you'll have funds tied up in increased amounts of accounts receivable. In addition, other cash drains may be that you will require both direct and indirect staffing to meet the needs, so you'll need to make sure you have the cash to pay for those. And in addition, you might need to upgrade your systems and your processes and capacity in order to deal with the larger volumes or clients. So this additional cash or working capital will really help ensure that you have success when you're ready to grow your business. So at this time, I'd like to go through 10 key steps that one has to think about when going through a growth projection process. So the first step being sales, then costs, then calculating your profit projections, margins, taking a good look at your balance sheet. What are your cash needs? ROI, return on investment, ROE, return on equity, ROA, return on assets, and finally the payback period. So at this point, something that might be really useful at this particular part in the presentation is to actually have the 10 steps listed out, either on a piece of paper where people can see or listed up on a board. I find that it helps people relate better to the overall if they can actually see the 10 all at one time while you explain the different parts of it. So this particular slide helps us figure out our projected growth strategy, that is, sales. So the first thing you want to do is you want to identify your growth opportunity, and that can be based on customer need. It can be based on your knowledge of your sector and knowing what product innovations are coming about. And it can also be based on your expertise in knowing and understanding what new markets are arising. Once you know your growth opportunity, the next thing you'll need to do is project your customer demand. And you may already know this from your interactions with your customer, or you may actually want to solicit information back from your customer by sitting down with them. Once you get that, then you can project your revenue. And this will be based on your projected sales volume, your estimated additional production costs, and then of course it's a calculation for you to figure out what your projected revenue will be. So after you've figured out revenue, the next significant piece that you need to get to is projecting growth, the costing side. So when costing, as you know, as business owners, you know you have direct costs and indirect costs. So those direct costs are things like direct labor, materials, inventory. There are also indirect costs, and those ones are the ones that are more like overheads. So it could be some corporate overheads, could be advertising, could be system upgrades, but you need to keep all these things in mind. In addition, you may actually need to invest in greater plant, property, or equipment, and you would need to figure out what additional capital costs, which you can prorate over a longer period of time, but you still need to figure out what you'll need and how much it will cost you for each period. So now that you've figured out your sales volumes, your costs, and your expenses, the next step is really to put that information together. And for that purpose, we use a pro forma or a projection. And this statement will show you how the numbers tie together, and it will help you understand the impact in terms of what does it mean to you bottom line. And it's important to work this pro forma because it's something you can play around with, and it actually is a simple way to try to understand the numbers that we've calculated. So for example, on this particular slide, you'll note that we've identified gross profit or margin, operating profit or margin, in addition to the bottom line or net profit or margin. So on this particular slide, it shows us the results as at June, and then it projects some changes through to December. And what you'll see is that sales have grown by 25%, cost of goods sold grew by 30%, and operating expenses grew a nominal 10%. Now, when you do your own pro formas, you can play around with the numbers, make different assumptions, really make this chart work for you. So at this point, this is a great opportunity to get participants in the class more involved and to really apply a little bit of what's just been learned. So for example, they're experts in their own business. So if you get them to buddy up in pairs and actually talk to each other about their operating costs and their drivers and what would happen if they made certain investments, it makes the learning more relevant and real to them. And that should be useful for the rest of the program as well. So this slide helps you analyze margins better. So for example, it lists all the margins, and I would really encourage you to take a look and understand the numbers well because it tells you a story and an important story. So for example, if you have margins and profits going up, things are probably good. That growth strategy is probably going to work for you. If you have margins decreasing slightly but still profit going up, it could be good, but you want to analyze it carefully. It's telling you a little bit about making less per unit, but overall growing your strategy, growing your business. If it's the other way and your net profits are down and your margin is up, well, you want to be very careful about whether that's something you want to get into. And if both your margins are down and your profits are down, you don't want to go there. The trick is to really try to understand the information that these margin numbers and profit numbers are giving you. And feel free to play around with it. Change your assumptions, make it work for you so that you can do the projections well. So presenters, for this last slide, you may want to keep in mind that your small business audience may not be as familiar with definitions of gross margins and operating margins. So when you're facilitating this part of the discussion, you may want to help to define it or make sure that they understand what the difference is, because it's really important that they make this information work for them. So this particular slide shows a simple balance sheet that a small business owner may find very useful. What's interesting is it shows the existing and the projected, and you'll see some growth in both the inventory numbers as well as the accounts receivable numbers, which means that the need for working capital increases. In addition, there's a slight increase in current liabilities, and again, they'll need cash to pay. At the bottom of this balance sheet, you'll see that the requirements for working capital have grown from $90,000 to $110,000. So to your business owner, they need to understand that this kind of a statement is useful to them because it gives them information that they can then plan for and use in their business. And in this case, it's the need for greater working capital. So building on the last schedule, this particular slide shows us a cash needs analysis. And small business owners will find this useful to document and understand how have their cash needs increased. So in this particular case, we show the increase of $20,000 in working capital that's needed to fund inventory and accounts receivable. But it also shows an increase of $100,000 required for a capital investment in equipment, totaling $120,000. The reason the schedule is important is because if one needs to go to a loan at a bank or needs to get an investor, they will need to be able to articulate their needs for the cash, thus helping to ensure their success for their cash needs. So a business that's not able to articulate its cash needs will have difficulty obtaining financing from a bank or from an investor and won't be able to get the required financing it needs for growth. So the final step in projecting growth is analyzing the overall profitability of that growth. Ideally, you should have a projection of long-term return for your business in order for your growth to be viewed as good or positive. So profitability can be analyzed in a number of ways using a number of financial ratios. We can look at return on equity, return on investment, return on assets, and finally we should consider the payback period for this. So over the next few slides, we'll discuss those indicators or ratios in greater detail. So return on investment is the indicator we're going to take a look at right now, and it's a very common indicator and a useful indicator for business owners. It is the amount of return that a business owner gets on investment, and it's defined by the profit increase in the numerator divided by the investment. In this particular example, you'll see that the business owner is getting a return of 5.75%. Now, this has to be looked at relative to the business owner's cost of capital. So for example, if a business owner would otherwise get a 10% return, then this example isn't looking so good. If, however, the business owner only gets a 2 to 3% type of return, then this investment actually looks very sound and something that the business owner should be interested in pursuing. So this second indicator that we're going to look at, return on equity, measures the return to the owner on their investment in the business. And it's defined by the increase in net income divided by the owner's equity. In this particular example, we see that the existing ratio showed a return of about 20% to the owner. After they made their change, their growth in the business, the projected return rose much more substantially. It's now 42.4%. So all things considered equal, this would look like a good ratio, and whatever actions the owner is undertaking, it shows that they are going to enjoy the rewards of whatever investment is made. In this particular case, because owner's equity remained at $40,000 on both calculations, you'll note that the owner obtained the cash for the expansion or the growth from the bank. So this measure, return on assets, measures how effectively the business assets are being used. So in this particular case, the formula for return on assets is the increase in net profits divided by the net assets. In our example here, what you can see is the denominator has increased from $100,000 to $200,000 because the owner has invested significantly in the assets of the business. What this results in, though, is that the ratios go down because the calculation shows us going from 11.21 to 8.48. So although the ratio is going down, this doesn't necessarily mean it's all bad news. The business owner will have to consider very carefully whether making this significant investment in the assets is necessary to remain competitive, gain new customers, or establish their longevity in the market. It needs to be looked at, and it's an important indicator. The final indicator we're going to look at is payback period. The payback period measures the time required to recover the cost of the investment. And it's calculated by dividing the total cost of the investment by the increase in net profit. In this particular example, you can see that the payback period is 17.4 years. Relatively, it sounds like quite a long time, because when you think of technology and innovation, you really don't know where you're going to be in 17 years. So the shorter the payback period, the better it is for business, the more effectively you can control your results during that period. So short payback periods are more desirable than long payback periods. So what have we seen from the indicators that we've just taken a look at? Because they do relate to each other and they help business owners make good decisions. We've seen that return on equity went up. We've seen that return on assets went down marginally. We've seen that the return on investment amounted to 5.75%, which is an okay return if you look at today's low interest rates. And we saw that the payback period was 17.4 years. For me personally, that last indicator is the one that I like the least. 17 years is a long, long time to see the payback of some equipment. And by looking at all the indicators together, I as a business owner can try to figure out ways, actions I can do to influence the indicators. So for example, in this particular example, I would try to see if there were ways for me to increase my net income in those first few years, because that will shorten the payback period on my equipment and really make the business case for expanding in this growth opportunity much more sound. So volunteers, that last summary I gave where I talked about the 4 indicators and how they interrelated to each other, that's a really important opportunity for you to engage the people that you're presenting to, because you can help them understand how those indicators work together, and you may have experiences or different perspectives on the example I gave. But in any case, it's your opportunity to help them really see how they can use those indicators to make really good growth business decisions. So sometimes, as a business, you can be faced with a great situation, and that is the potential for unexpected growth. So what happens when you have unexpected growth? How does this happen? Well, a customer could place an extraordinarily large order. Could be one of your competitors has left the field. Or perhaps you got a really favorable review and all of a sudden you're being inundated with attention. At the outset, you must determine whether this growth opportunity is going to be profitable for you or not. So unexpected growth, how does it impact your particular business? So for example, how much more working capital will you need? And if you need it, will you be able to access it? Do you have ready access to funding, to investors? Will you need to invest in something more permanent, like capital? Will you need to have longer leases? Will you need to staff up, and what might that entail? Will your systems need to be upgraded, and what might the cost and impacts of that be? All of these things will need to be considered. It's great to have the potential for growth, but again, you're in business for the long term, and you need to figure out what it's going to mean to your business over that long term. So at this particular time, in terms of unexpected growth, we want to consider initially the financial impact. So you've given some thought as to what else you'll need to facilitate the growth. So when you figure out the costs, what will that do to some of your profit margins for your business? Go back and recalculate some of those key indicators we talked about and figure out, in terms of return on investment, return on equity, return on assets, what do those numbers tell you now in terms of either supporting or not supporting your growth strategy? Once you have those numbers in hand, the financial impacts, you'll want to consider the organizational impact. So, can your management take on this extra growth? Do you have adequate staff? operational capacity and systems capacity? And importantly, what type of effect will this have on some of your long-term customers? Will they be able to remain happy and satisfied while you pursue some aggressive growth strategies? You have to make a long-term decision taking all of this in mind. So at this time, we're nearing the end of this particular presentation and wanted to point out that in your package, there are a couple of takeaway pieces that we hope you will refer to as you pursue your growth strategy or not. And included in the package is a glossary of terms and definitions, as well as an implementation checklist. And these should help you at a practical level to move forward with some of the concepts that we've discussed here today. At this time, I'd like to open up the floor to questions that you may have about the presentation. So presenters, this presentation had a lot of complicated concepts for people who are new to some of the material. So you'll want to do your best to answer the questions they have. However, if you get asked very specific questions which seem very personal in nature, you'll want to make sure that you refer these people to their personal financial advisors so they can get the personalized advice that they need. Thank you for joining me today at this session on growth and expansion, how to grow your business, part of a series brought to you by CPA Canada, Financial Literacy. It's been a pleasure. So now go out and grow your business.